Hey everybody, what's up? Chris Kiblin here over at Movement Mortgage, and today I am here with Stan Turdinov with Preferred Shores. Hey Stan, how are you today?
I'm very good, Chris. Nice to meeting you, and thank you for having me here.
Oh, you're welcome. So we want to kind of talk a little bit about mortgages and what's going on in the mortgage world, and I know you got some questions that you wanted to ask, so let's go.
Correct. Yes. First thing first, there are talks about current market and interest rates going up, and I think people would like to know and hear from, local expert in the mortgages like you, where is the market of mortgages heading at this point?
Sure. Yeah, so the interest rates are kind of a little crazy right now, right? Give me like 6 months ago and we were in the twos on a 30-year mortgage. So now we're probably sitting somewhere in the mid threes now on interest rates for a 30-year, depending upon credit, depending upon how much they're putting down. So there's some variables there, but kind of that's about the average. It's about 3.5% right now. What we're predicting and what the Fed's predicting, I mean, they're going to think that we're going to have 3 more rate hikes this year. So we're not sure, right? Because the biggest things that we're really following, so one of the things that affects interest rates is the inflation. We're seeing
Correct.
Inflation going up, right? We're seeing gas prices go up, food prices go up.
Everything.
Housing prices go up, right? Especially here in Sarasota and Tampa. And so that's one of the things that we're seeing. So that's causing interest rates to go up. And we expect them to keep going up. It's a good thing and maybe a bad thing, right? Because interest rates are going to kind of make the payment a little bit more. But the thing is that it may slow up some of the housing market as far as inventory, because inventory is one of the biggest issues right now.
Correct. Yes.
So that's kind of where we see the interest rates going right now. So, but hopefully, I think it's going to be a slow start. It's not going to just all of a sudden be 5%. I think we'll stick here, then we'll gradually go up a little bit. But who knows? Maybe it goes back down. You just don't know, right? So,
I mean, one thing that I see is that the interest rates have been substantially lower for the past year, 2 years compared to, look back 5-6 years ago.
Yeah.
And they went down, and that obviously created much higher demand and more buyers on the market as well. And on top of the inventory being low, but if there's 50 houses and there was 50 buyers prior to that, there's now 50 houses or 40 houses and there are 200 buyers
exactly
competing for that. So, and yet, whatever it is, interest rates up or down, still cheaper to own versus rent.
Exactly.
So,
yeah, absolutely. So, that's the thing. One of the things is you're going to take a look at is if interest rates still keep going up, right? I mean, the housing market's going to keep going up. We don't see that slowing down for a little bit, right? So I think it behooves anybody who's thinking about buying right now might be the best time to do it. If you haven't done it so far, at least get into it. I know it's a tough market, but I mean, if we're at 3.5 now, we could be at 4.5 by the end of the year. That's a big difference in your payment. We're probably talking a couple $100
Correct.
At least in your monthly payment. So, it's smart to kind of start looking and at least get into it before that does happen, if you can.
Yeah, for sure. Let's talk about a little bit, requirements for the buyers and how important that is to have a solid pre-approval. I know how important it is on my end, when I submit an offer for a buyer, but I just want, people to know the whole process of, credit scores, requirements of different, conventional FHA mortgages, and what does it mean to have pre-qualification versus pre-approval?
Sure.
Because as I said, I know what it means on my end and how the process later on can change when you get to the point that you do underwriting and many people get frustrated. Why? They're asking me for this document and this piece of paper, and they're very strict actually guidelines for you guys to make a mortgage happen.
Exactly. So there's different guidelines for each different product, right? So FHA, conventional, whether it's VA for a veteran loan, there's jumbo loans out there. Each one has a certain requirement on credit scores, right? Now on FHA, we can actually go all the way down to a 500 credit score with 10% down, depending upon what's on their credit. But typically we want everybody to be over 580. Okay, so that's for FHA. The other thing that you want to look at is what we call a debt to income ratio. That's a huge part, right? That's where we take your monthly debt and then we divide it by a percentage. And that percentage is how much you can have in liabilities. So the liabilities is your first home, like this is say it's your mortgage payment, your car payment, your credit card payment. We take all those, and this is say it's 50%. So if you're making $3,000 a month, you can't have no more than $1,500 a month in debt, and that's the mortgage payment, the car payment, everything added up. So that kind of gives you an idea of where you need to be. So that is very key. A lot of people don't understand there's a debt to income ratio. Of course, there's a credit score, right? And then it also comes to down payment. How much can you put down, right? So, FHA can be as little as 3.5% down. First-time home buyers could be as little as 3% down. And one of the big misnomers, and I'll talk about real quick, is that a lot of people think that they got to put down 20%. Right? I still get these calls after all these years, and it hasn't been like this for years.
Yeah.
Right? Yeah. Oh, I thought I had to put down 20%. And I'm like, no, you don't need to put down 20%. You can put down less. 20%, all that does is that avoids what we call private mortgage insurance.
Correct.
So that just basically you wouldn't have mortgage insurance on a conventional financing. You could put down, like I said, as little as 3% for first-time home buyers, 5% if you've already owned a home. For conventional financing, FHA is a little as 3.5%. And then even on VA, you can do 100% financing on a veteran loan.
Yeah.
So, and then one of the things that you want to talk about also is closing costs, okay? Because closing costs could be key, right? In the state of Florida and where we live, closing costs sometimes could be a little pricey compared to other states. And we can't control the transfer tax and recordation tax and that kind of stuff. Yes. So, but you're looking at whatever the purchase price is, about 2.5% to 3% of the purchase price towards closing costs. So sometimes people think that, well, can I just roll my closing costs into the loan, or can I just, or whatever, and you can't. So you need to make sure that if whatever you're doing is that if you have your down payment and your closing costs, because you're going to need both. For that. So kind of plan on having about 2.5% to 3% towards closing costs, and then whatever your down payment is going to be.
Right. What options are available for people who would like to invest?
Okay. So
especially down payment requirements, because I've heard different, anywhere from obviously investment loans are a little different than, standard purchase for primary residence. So many people would like to get something, either rent it out and, move in a few years. But, I've heard anything like 15% as a minimum, all the way up to as many as you can afford.
So I usually tell people, like, there is a 15% option. So conventional financing through Fannie Mae does allow it. The problem is the mortgage insurance, because you still have to get mortgage insurance. And and mortgage insurance is a third-party vendor. Right. Through not through the mortgage company. It's actually a different company that holds the mortgage insurance. Most mortgage insurance companies, they won't do investment properties. So they don't want to get involved in investment properties. And if you can find it, it's so expensive, then it doesn't even make it worthwhile. So I always say, like, at least 20% down. That's going to be your investment property. And then sometimes it could be 25% down, depending on the property, if it's a multi-unit property. So like if you're looking at something that's got more than 2 units, then that can actually be 25%. So you just want to kind of know, okay, single family home, or that could be as little as 20, multi-unit could be 25. So that could change the game on that, right? The other thing is that you want to make sure that you understand that this isn't like a primary mortgage. Interest rates on these are higher. Correct. Because it's an investment property. Anytime you add risk to a loan, it affects the interest rate. Yes. So investment property, credit score, down payment, the more you put down, the better the interest rate's going to be. One of the great things is if you can put down, like if you really want to get the best rate, put down 30%, because, and depending on our credit score, that's going to give you, because then there's no adjusters. We have adjusters for depending upon how much you put down in credit score. So, but investment properties, around here, a lot of people are looking for investment properties, but a lot of times they don't realize that you need to put down at least that. Trying to find 15% down, I've done them in the past, but they're tricky.
Yeah. How about refinancing? That was a big thing, for the past few months, especially after COVID started. But one thing I looked at, refinancing. It doesn't have to be because you need to lower your monthly payment, but you can actually use the equity of the home even to do a cash out and invest the money that you actually have in your home instead of selling it, but you can just buy another property if you have good equity in it.
Well, you see how the market's changing, right? I mean, there's neighborhoods that are around here in the Sarasota area that I know that some of them, the houses have almost doubled in price, right?
Yep.
So, like, I mean, you figure if you got that kind of equity, and we're seeing this, and I'm still doing a lot of refinances just because of this reason. A lot of people are taking out the equity out of their home, and they're either paying off debt or they're investing it into another property or investing into some business. So there is those options where you can take that money and use that money to work for you. I think it's great if you take that money and then you reinvest it into another property and then you become an income-producing property.
Correct.
Right? So if you can become an income-producing property with a rental, I mean, now you're making money off of your money,
Yeah.
And so that, and the little amount that is going to cost you to refinance and get that extra money out, for that monthly payment, but you've got this other income coming in. That's a nice piece of income stream, especially as, if you're looking at retirement and that kind of thing, or you're looking at later on down the road where you can actually have more income and you retire. Well, now I've got this income coming in. Well, now I can that could be part of my income that I can live off of.
Correct.
So
and you still owe another property.
And you still own
now
another
instead
property.
Of one, you have two,
Yeah. So I mean, and the great thing is let's say also let's just say something happens and you need to sell the property. Well, now you got this nest egg over here of a property that's appreciating, right? And then every year, and it's making you more money. Especially in our market right now, is going the way it's going up. It's a great time that you can get that, and then you have a little. If I need to sell it real quick to for whatever reason, then I sell it and I'm making money off of that. So it's a great thing to think about. I mean, if you ever look at most of the people that are really successful in this world, they get into rental properties, investment properties, and because that's where you can make really good money at.
Yeah, and the other thing, even if you don't do a cash out refi, say you purchased your property with lower down payment, 2 years ago, 3 years ago, with the equity that you have right now based on the current market, you can still do a refi and, get to the 20% bracket where you're not going to pay your mortgage insurance. Which is going to lower the payment.
Well, that's the great thing is like I have people doing that too, right? So I have people that are actually, because they had mortgage insurance before a couple of years ago, so they're refinancing, getting rid of their mortgage insurance plus taking cash out to pay off a car or pay off some credit card debt or whatever. So now they're like, okay, my mortgage payment went down a lot. I mean, I don't have a car payment anymore, and so like now they're feeling much more comfortable too. And so it's like, okay, well maybe now they can also look at doing some other things.
Yeah, definitely lots of options. I guess that's very good information, to share. And if anybody watching have any questions specifically, we'll have Chris' information available as well to reach out to him and talk about, different options. And thank you so much. Really appreciated your time, and hopefully we'll meet again in future and do another, videos and stuff like that.
Yeah, absolutely. Looking forward to it.
Absolutely. Thank you.